All right, let me ask you something straight up. Because if you're anywhere near retirement age or already there, this matters more than you probably realize. The new 2026 tax law that just kicked in is going to change your tax bill in ways nobody is really explaining clearly. And if you don't understand what's happening, you could end up overpaying the IRS by thousands of dollars every single year for the rest of your retirement. I'm talking about a brand new $6,000 senior deduction that most retirees have no idea even exists, a bigger standard deduction, changes to how your Social Security gets taxed, a completely rewritten SALT cap, and a window for Roth conversions that honestly might be the best opportunity we've seen in a decade. So grab a coffee, sit down, and let me walk you through exactly what changed, what it means for your wallet, and the moves you should be thinking about right now before the year gets away from you. Let's start with the big one, because this is the change that's getting the least attention but is going to put the most money back in your pocket if you're 65 or older. The new law created what's officially called the Senior Bonus Deduction, and it's worth up to $6,000 per person. That means if you and your spouse are both over 65, you're looking at $12,000 in extra deductions stacked on top of everything else you already get. Now, here's where it gets interesting, because this isn't replacing your standard deduction. It's not replacing your age-based add-on. It's bonus money on top of all of it. So picture this. You've got a married couple, both 67 years old. They take the standard deduction, which for 2026 jumped up to around $32,000 for joint filers. Then they get the existing senior add-on of roughly $3,200 for being over 65 each. And now, on top of that, they get this new $6,000 senior bonus per person. Add all that up, and you're talking about more than $50,000 of income that's completely shielded from federal tax before you even start counting anything else. That is a massive shift, and a lot of retirees who used to write checks to the IRS every April are going to find themselves owing nothing or even getting a refund this year. But here's the catch, and there's always a catch. This senior bonus deduction has an income phase-out. If you're single and your modified adjusted gross income goes above $75,000, the deduction starts shrinking, and if you're married filing jointly, it starts phasing out around $150,000. Once you hit certain higher thresholds, the deduction disappears completely. So this is really designed for middle-income retirees, the folks living on Social Security plus a modest pension, or some IRA withdrawals, and it's basically the government's way of saying, we know you're on a fixed income and we want to give you a break. If you're a higher income retiree, you're not going to get the full benefit, but stick with me because there are other moves you can make. Now let's talk about Social Security, because this is where there's been a ton of confusion. You've probably seen headlines screaming that Social Security is now tax-free, and I have to gently tell you, that's not exactly true. What actually happened is that the new senior deduction effectively wipes out the federal tax on Social Security for a huge number of retirees, but it doesn't technically eliminate the tax itself. The way Social Security taxation works hasn't really changed at the structural level. Up to 85% of your benefits can still be included in your taxable income depending on your provisional income. But here's the magic, because that $6,000 bonus deduction gets applied to your total taxable income. For most middle-income retirees, the math works out so that the tax owed on Social Security essentially gets canceled out. So functionally, yes, a lot of you are going to stop paying federal tax on your Social Security checks, but it's because of the deduction, not because Congress actually made Social Security tax-free. The difference matters because if your income goes up, say you take a big IRA withdrawal one year, the tax on Social Security can come roaring back, and you need to know that going in. Now let's draw out what this actually looks like with real numbers, because I think examples make this stuff click. Let's say you and your spouse are both 68. You're collecting $48,000 combined in Social Security, you've got a pension bringing in $20,000. And you pull another $15,000 out of your traditional IRA. That puts your gross income around $83,000. Under the old rules, you would have had a chunk of that Social Security taxed. You'd take the standard deduction, and you'd probably owe somewhere around $3,000 to $4,000 in federal tax. Under the new 2026 rules, you take the bigger standard deduction of $32,000. You stack the senior add-on of around $6,400 for both of you being over 65, and then you add the $12,000 senior bonus deduction. That's more than $50,000 in deductions against $83,000 of income, which drops your taxable income down to around $33,000. And at that level, you're in the 10 and 12% brackets, and after the Social Security calculation works through, your actual federal tax bill could be close to zero or maybe a few $100s. That is a multi-thousand-dollar swing in your favor, and it happens automatically just by filing your taxes correctly. Let's move over to the SALT cap because this one is huge if you live in a high-tax state like California, New York, New Jersey, Illinois, or anywhere property taxes are eating you alive. Under the old law, you could only deduct $10,000 total of state and local taxes, which included your property tax and your state income tax combined. That cap was brutal for a lot of retirees who own their home and have been paying $12,000, $15,000, $20,000 a year in property taxes. The new law raised that SALT cap dramatically, all the way up to $40,000 for most filers. That is a 4 times increase, and it suddenly makes itemizing your deductions attractive again for a whole bunch of people who had given up on it. So if you've got significant property taxes and you give to charity or you have mortgage interest, you need to actually run the numbers both ways this year. Take the standard deduction with all the senior add-ons and compare it to itemizing with the new $40,000 SALT cap. The answer might surprise you, and for higher income homeowners in expensive states, itemizing could now save you several $1,000s. Speaking of itemizing, let's talk about charitable giving because there's a really interesting new twist. The law brought back an above-the-line charitable deduction, which means even if you take the standard deduction, you can still write off some charitable contributions up to a certain limit. It's not huge, we're talking a couple thousand for joint filers, but it's free money if you were already donating anyway. And if you're itemizing, charitable contributions are still fully deductible up to the normal limits, which makes strategies like bunching donations or using a donor-advised fund really powerful right now. If you're in your early 70s and you're subject to required minimum distributions from your IRA, the qualified charitable distribution is still your best friend. You can send up to $108,000 directly from your IRA to a charity. It counts toward your RMD, and it never shows up on your tax return as income. That's the cleanest way to give to charity in retirement, and the new law didn't touch it, so it's still sitting there waiting for you. Now, I want to spend some real time on the Roth conversion opportunity because honestly, this might be the most important strategic move available to you under the new law. Here's the thing, tax rates right now are historically low, and even with all these new deductions, the rates are scheduled to stay where they are for a window of time. But nobody knows what happens after that. Congress could raise rates. Your RMDs are going to start kicking in at 73 or 75, depending on your birth year, and those forced withdrawals can push you into higher brackets and trigger more Social Security taxation and higher Medicare premiums. So the play is this. In the years between when you retire and when your RMDs start, you have this golden window where your income is low and you can convert chunks of your traditional IRA over to a Roth IRA. Pay tax on it now at today's low rates, and then never pay tax on that money or its growth ever again. With the new senior bonus deduction lowering your effective tax rate, you can actually convert more money each year and stay in the same low bracket. Let me show you how powerful this is. If you've got $1 million in a traditional IRA and you do nothing, your RMDs starting at 73 could be $40,000, $50,000, $60,000 a year of forced income, which could push your tax bill up dramatically and tax your Social Security at the full 85%. But if you spend the years between 65 and 73 converting, say, $50,000 a year to a Roth, you pay the tax now while you're in the 12 or 22% bracket, you shrink your future RMDs, and you build up a tax-free bucket that you can pull from any time without affecting any other tax calculation. That is a game changer, and the new law makes this strategy more attractive than ever. A couple of other things you should know about. The estate and gift tax exemption got bumped up significantly, so if you're in the camp where you're worried about leaving a large estate to your kids, you've got more room to do gifting and estate planning. The qualified business income deduction for small business owners and certain self-employed retirees got tweaked and is more generous in some cases. And there are some new provisions around health savings accounts that let you contribute more if you're still working part-time in retirement, which is something a lot of folks overlook. So, what should you actually do with all this information? First, sit down and run your numbers, either with a tax professional or with good tax software, and figure out whether the standard deduction with all the senior add-ons beats itemizing with the new SALT cap. Second, if you're between 63 and 73, seriously look at Roth conversions this year and every year until your RMDs start, because the window is open and it won't be open forever. Third, if you're charitably inclined, think about whether QCDs or bunching donations makes more sense for your situation. And fourth, please don't just file the same return you filed last year and assume everything's fine, because the rules genuinely changed, and missing these new deductions is the same as handing the IRS free money. If this helped you understand what's coming, do me a favor and hit that like button. It really does help the channel reach more retirees who need this information. And subscribe so you don't miss the next video where I'm going to break down the absolute biggest Roth conversion mistakes that people are making right now. And if you watched all the way to the end, drop the word deduction in the comments so I know you're one of the serious ones who actually takes their retirement planning seriously. Let me know your biggest question about the new law down in the comments, and I'll do my best to answer as many as I can. Take care of yourselves, keep more of your money, and I'll see you in the next one.